Okay, well, let's get started. And I'm so thrilled to have everyone here today. My name is Erin Cunningham Ritter. I'm representing the College of Arts and Sciences Be Well program, and I'm so pleased to welcome you to this Let's See You Well event titled Building a Secure Financial Future. Back by popular demand, we have one of our favorite partners, Diane Hirschhorn, who is a lecturer of finance in the Leeds School of Business and was previously a wealth manager. This presentation is part of a series that Diane has collaborated with us on, and we have her previous workshops or sessions posted on our Let's See You Well website, which you can check out at the link I just posted. Also, before we begin, please note that closed captioning is available by clicking on the live transcription bar or live transcription button in the menu bar. We will record this session and feel free to ask questions throughout the presentation. And Diane has said I'm allowed to just jump in if the question is particularly relevant. But one thing to note, Diane can't give specific financial advice. And so try to frame your questions as general as possible, like that it would apply to multiple people, not just your unique situation. So with all that said, I am pleased to introduce our Be Well Expert of the Month, Diane Hirschhorn. Diane has over 20 years of wealth management experience as a financial advisor, providing complete wealth management strategies to clients. In addition, oops, sorry about that. My screen share just messed up a little bit. I'm going to get right back in there. There we go. Okay, so in addition to lecturing at CU Boulder, she is currently a consultant at two financial institutions. She previously worked as a managing director at First Republic Bank and also at Merrill Lynch and Goldman Sachs. During her career as a wealth advisor, she received several industry awards. At CU Boulder, she was a Marinus Smith Award recipient. Ms. Hirschhorn received a Bachelor of Arts degree in economics from Cornell University and an MBA from the Anderson School at UCLA. She is also a certified private wealth advisor. I am so thrilled to be able to pass things over to Diane. Thanks so much for being here, Diane.
Thank you. It is such a pleasure talking to you all. Like, my mission really is just to make financial advice easy, to understand. Like, there's a whole business that is in place, in my opinion, that is designed to separate you from your money. And so my job really, is to just help make this easy and engaging. And I would appreciate if you ask questions along the way. There's nothing that is off the table except for legally, just to be able to talk to you. The companies that I consult with want to make sure that I don't provide specific financial advice to you. We're going to talk all about finances today. And for some reason, this share did not work. Give me one sec. Okay. Can you all see that? Okay, great. I go by Diane. I don't go by professor. I don't have a teaching degree. I don't have a um, PhD. I just have experience. And so I always ask my students to call me Diane, and that's what I'm asking you all to call me. Erin already went over my background. The main thing I like to say at the beginning of these presentations is for many years I was managing the rich and the famous, like Hollywood entertainers and famous CEOs. And one day when I was 50, I woke up and I had this epiphany that, like, if I were to die at that moment, like, of course, like my kids would just say, like, hopefully great mother and great spouse and friend, but really professionally, the epitaph would have read, made rich people richer, which kind of didn't have the ring that I wanted it to. So I sold my business. I decided that was it. I was done. And then CU coincidentally asked me to teach one class, and the subject was advanced portfolio management. And boy, I thought I was just going to do one class, and I really love it. Like, I feel like there's magic in a classroom. And so that's really what I love to do now. And now I teach at 60%. I have to say this, I'm not going to read the disclaimer, but as I said, really, this information is content that will hopefully be engaging and valuable and will give you tools so that you can make better financial decisions. But I don't know any of your personal financial situations. For your benefit, it would be better for you to just take this and say, wow, I want to learn about that. But please don't take it as financial advice. Um,
Diane,
so today,
while you're pulling up your slide, best comment ever from Ben in the chat. He says, Diane has made me slash saved me thousands of dollars from watching her CU webinars.
oh, Ben, I can't see your face, but that is like, I'm just going to stop this talk right now and go to sleep because that honestly is really what I'm trying to do. So that really just touched my heart. I can't thank you enough. So I feel like I said to Erin, like I wasn't going to talk about current markets, but I said, Erin, stop inviting me to speak because I had this epiphany. The last two times I've spoken, we've had some major event happening, and I felt compelled to try to talk about current markets. And right now, like over the weekend, like we're having a war suddenly with Iran, and markets are expensive and people are stressed. And so, like, the best thing for all of you is to never ask me to come back. And then I think the markets hopefully will just go on without any volatility. I'm obviously being facetious, but I do want to talk. Oh, shoot. Sorry about that. I do want to talk about what's happening in current markets and tell you maybe a few thoughts on how to stay calm if there's more volatility. I want to talk about the overall structure of deciding between types of retirement accounts this time. Should I participate in traditional either 401ks or IRAs or Roths? And I know some people are participating in para. The bulk of the people on this call are not. The previous lecture I gave, to the extent you have para, will talk about investment choices, how to optimize them. This is more a conversation of how do I decide for me, for my spouse? Like, should I participate in these retirement plans? And how do I make this distinction? Which one's best for me? And then also it's come up over and over again in these lectures, like, how do I make the decision? Should I be paying down my debt first, or should I invest? And how do I create a framework to do that? If we have time, I'd like to talk a little bit about these college retirement savings plans, college savings plans called 529 plans. Should I consider doing it? What are they? And how do I decide also? Do I participate in that and help my children save for college, or instead, should I be saving for my own retirement? How do I make that decision? So, okay, I always like to review this. Like the overall goal and why Erin and her group sponsor this is I'm trying to help tie in finances with being well. And what I try to tell my students is everyone on every income can achieve financial independence. You don't have to be rich and famous. As a matter of fact, I learned from my career, um, being rich and famous, they had the same problems that you and I do, right? It's just, I had one client want to do a remodel of a bathroom. She's a very famous singer, musician. And instead, I don't know what a typical remodel cost on a bathroom. Like, let's just say it's $10,000. Let's make up a number, maybe 15. And so this is maybe 10 years ago. And she calls me on the phone and she says, listen, I just really need to remodel my bathroom and it's going to cost me $250,000. for a powder room. And like, if you're stunned, I am speechless in this meeting because even someone as wealthy as she was, like, she just couldn't control her consumption. And so, like, I had to try to tell my clients too, as well as you, like, we can achieve financial independence at any level. And what that really means, a rich life to me, is never about consumption. A rich life is about owning your own time. And so that's really what I'm hoping each of these lectures give you different tools so that ultimately your investments, your portfolio, which could be a combination of real estate and maybe some stocks and maybe some bonds, maybe some rental property, like a host of different things, maybe Bitcoin, that your investments ultimately can generate enough income so that today I'm really teaching at CU because I love to do it. I'm not doing it primarily because I feel motivated by the income. It's because I feel like I'm doing good. And so that is a great gift. And how this ties in more specifically is um, to being well is one of the biggest stressors in our lives. And frankly, our marriage, the number one reason why people get divorced in the United States are fights over money, different styles of investing, different styles of savings. And so having lower stress will help you have better well-being. It will give you more control over how you spend your time, and it will just give you more security at any income level. So now I want to talk a little bit about current markets. My husband would say you're smiling, you shouldn't smile when things are so stressful. And so like the S&P 500, which is a barometer, it's what it's called an index. And if we looked either at the New York Times, the Wall Street Journal, on the news, any source, um, like that's the main like benchmark mark or barometer that people use to measure the performance of the US, the United States equity markets. It's done almost nothing year to date. It's down a little less than 1%. That's just nothing. It's not up, it's not really down, it's done nothing. I would say, however, like these headlines we've been seeing lately, regardless of your political affiliation, it's just unsettling to see like pictures of like us going to war, of devastation, of oil prices going up, of wondering how that impacts us. And that can affect not only big companies, but also smaller ones. And so, even if over long periods of time, I at least believe that stocks are a great way to build long-term wealth for anyone, it just can be really unsettling and it can shake our confidence. And so, what I want to do is draw parallels right now to things I see. This is, again, absolutely not investing advice. But if I were talking to my clients right now, I'd probably be saying things like what I see right now, or some things that remind me of comparisons both to the market of 2000, which was at the very beginning of my career, and also 2008. The other big correction that we all experienced was the correction of 2020. I removed that one because it was just such a weird one. It was caused by the pandemic. Markets went down very fast. But what was very unusual is it really rebounded incredibly fast in like historically unprecedented. And again, I'm not giving you investment advice, but I would say if the market and when it corrects, it's really when rather than if for me. It's not that I'm suggesting something's going to happen tomorrow, but if Erin is still inviting me to do these lectures in 5 years from now, I'm going to make an argument that it's unlikely that we haven't suffered some very significant pullback. Why do I believe that? Let me start with 2000. So I was young and naive, but what I did see is valuations for those who are old enough like me to remember this, they were just expensive. Stocks were very expensive. I'm just telling you right now, we don't have to go through different metrics to understand why, but if I could have just an hour presentation making an argument that I think the markets um, are pricey, they're expensive. And so think about it like any other thing you purchase. When stocks are more expensive, to me, I'm still investing. I'm investing right here. Because I don't believe I'm good at time in the market, nor is anyone good at time in the market. But I can tell you it's less of a good deal today than when it goes on sale, when it's lower. So I see kind of disturbingly to me a lot of signs that the market's similar to the technology boom of the late 90s. I'm seeing that today with AI. And it's not just AI. I just, if I look at the top 10 companies in the S&P 500, I'm not really super excited saying, wow, these are great deals. So my first concern with the market is it's just plain expensive. And what typically happens over time, at some time, the air is going to come out of the tire just because it's expensive. It just should reach fair valuation. I always like to say to my husband too, I know that we're in for it when in for market correction, when I'm going to cocktail parties and people said like I'm cool, like I'm the least cool person you'll ever meet. So if people want to talk to me, I know probably the market is starting to get too expensive. I don't know when, but at some point it's going to come in. 2008 is a little more interesting to me than 2000. 2000 again, just expensive. 2008 was really a problem with debt markets. To the extent you're interested in this crisis, The Big Short is a super interesting book and movie. And you don't have to understand all the different details. It's very entertaining. It might be worth watching to get a little bit more of an understanding about what life was like then. Because one of my concerns is all my students right now, like essentially, they think that the market is just going to go up. And I think a lot of people who have been investing since 2008, so we're looking at more than 17 years, essentially almost 18 since the last correction, they think markets only go up and they just don't. What happened in 2008, and the movie will describe this in a very entertaining way, is credit, borrowing. It just became too easy. And that is really what I'm seeing now in a different way. In my experience, credit problems, debt, borrowing, when it becomes too easy, what happens is standards, everybody's making money. So the banks start to lend at like to riskier and riskier customers. And that is really what happened in the housing crisis of 2008. And that's why real estate collapsed. And it really wasn't just the housing crisis, but there was so much leverage tied to it. It was like a gigantic game of Jenga. And that could happen today, where the basic structure of these blocks, building blocks, come undone for a bit. And there's the CEO of JP Morgan. His name is Jamie Dimon. And he talked about maybe 3 or 4 months ago what he called like he saw emerging cockroaches. And I just love this analogy because I lived in Manhattan for a while. And no matter how neat I am, there's always a neighbor who isn't as neat. And his point was if you see one cockroach in your house or apartment, it's very unlikely that there's just one. They have friends. And so he said that what he sees right now, and I think he's really right, it's just there are several signs where there's some problems with debt right now, or what's called the credit markets. That's really just lending. And so banks are exposed to this credit despite there being a lot of regulation. If you have time, there's an interesting book I read in the last 6 months, and it's called 1929. It's very engaging, and it just kind of takes you through like what led up to the crisis of 1929. And since that crisis and then the depression, we came out with all these regulations to prevent banks from failing. And by the way, I'm not saying banks are going to fail, but I think regulations were there to protect average investors and consumers like you and me. And the thing that's a little disturbing is now there's what I would call this private credit market. It's not just me, but you probably have heard other people saying, "Oh, you have to invest in private credit." And so what it is it's not regulated because it's not public. If it was a bank like Wells Fargo, Bank of America, um, and any of the investment banks like Morgan Stanley or Goldman Sachs, any of them, those are public companies, so they're much more regulated. So I think there's this shadow market of lending that's not well regulated. And so, and now Congress has allowed people like you and me to invest in it actually in our 401k plans. We can't yet at CU. I actually think this is a really good thing. I don't think it might sound sexy and exciting. I think there's danger with this. And so my concern, people are investing in things that are riskier and they don't fully understand it. And what happens is when you invest in a black box, when it goes well, you're excited. But if you don't fully understand it, people are going to sell when the market goes down. And so things that they think are safe, and this truly happened in 2008, people, even countries like Iceland and Ireland and Italy, senior government officials were investing in things called collateralized debt obligations and other really derivative instruments associated with debt, and they didn't fully understand it. There's leverage that it was associated with, and leverage is awesome on the way up. But leverage exacerbates gains, but also losses. And I really wouldn't be surprised if we have a period of unwinding like this. And ordinary investors will have exposure to this either because not at CU, but maybe some of your spouses have plans and maybe they've said, oh, we have to invest in this. And also, we all own the stock market. And when leverage unwinds, then people typically panic. So that it's not the same as what I saw in 2008. It's similar both to like a lot of other corrections in that that's typically lending becomes, in my opinion, only my opinion, a little too loose. Um, and then it might lead to some kind of correction. And so we should just focus, think through, like what do I think about? Like, I'm not saying it's going to happen tomorrow. Don't believe anyone who says it's going to happen tomorrow. No one knows. Like, it's just the music, what I'm saying, in a game of musical chairs when we're all little, at some point the music's going to stop. So I want to teach you a few tips and tricks. What would I do if I'm both under the age of 50 and over the age of 50? Simplifying this, how do I look at things? And so I would really just think about like, don't react emotionally. The market is just flat for the year. There is a war going on. It may get worse. It may all resolve. Maybe it does. But it's good to be prepared and think through it before we face that crisis. And so, really, let's, on a big picture, look at your plan. Make sure it's aligned with your financial goals. I'm going to give you a little bit more detail in a minute. Don't really react emotionally. Like I tell my clients or told them, I also tell my students, like almost everyone comes to me. Remember, like I'm dealing with these or formally with these entertainers and with senior executives of public companies. And so they all were risk takers ultimately. Like that's how they, like, I don't know how many Hollywood stars are successful. Less than maybe 0.5% of all great actors or musicians might make it. It's horrible odds. And yet they did. So they're risk takers. And yet, um, they all will tell me, oh, I'm totally comfortable with risk. And every single time when the market would go down, that's when they would call me and say, hey, you know what? I've kind of been reassessing my risk profile. It doesn't feel so good. Of course, it doesn't feel good, but the time to think about it is long before the market corrects. Because if it's correcting or going down and you've lost 20 or 30% of your capital, if you make a change then, it's very expensive because you're locking in losses, not gains. Okay, and so let's talk about some specific strategies. Do I have any questions up until that point before I talk about what I would do?
Yeah, Diane, there's one in the chat. Are private market equity funds like Ares an example of the unregulated private credit situation that
Yeah,
you?
so yes. So Aries has is like multiple funds with it within it, like not just one. Not all of their funds are private credit, but Aries is one of the companies that has private credit. There are a lot of them, and a lot of them are really well known and some of them have done well. But I can tell you that until the music stops, that doesn't mean it's going to hurt all of them. But again, the Big Short is going to be a really good thing to watch because you'll see a few people made money and a lot of people kind of didn't. So, any other questions? Okay. So, down markets. So, like, what would I do? So, if I arbitrarily pick 20 to 50 because these are people who have a much longer time horizon before they retire. And so, what would I do today? Like, long before the market corrects, no idea whether it's going to happen today, tomorrow, in a year from now, 5 years from now. So look at your savings rate. And I've said this before, like CU is an amazing place to work for so many different reasons. But one of them is all of us are saving at least 15% of our CU income. How do I know that? Because we all mandatorily, we have to contribute 5% into a retirement account. CU does it paternalistically. In all of my years of giving financial advice, I have never met an employer who, like CU, matches $2 for every dollar we put in. That's just insane. So if we put in 5%, which we have to, CU is matching with 10%, or we are all saving 15%, which is amazing. I would love for you to save at least 20%. So you're saving 15. If you look at your after-tax paycheck week by week or every 2 weeks, a goal you should have is to put away at least 5% of that. And the best way to do that is having it automatically withdrawn either into your savings account or an investment account. And I can comment more on that if someone has questions later. So trim excess spending. Like I'm at the end of this talk, I'm always looking for ideas. I try to take feedback from Erin and from you all. And I'm trying to structure this based on the feedback that I heard last time. I have had a few people say, could you just go over saving strategy? Like, this is great to have these investing talks, but what the heck? I'm barely getting by. So if you would like saving strategies or anything else, please let us know. Embrace the market volatility. So here's the strange thing, and I said this to my kids because my kids are 23 and 25, which is remarkable given that I'm just 26. And so I've said to them, they've only invested in an up market. And so my son's like, oh yeah, like I could totally take on risks. I'm so comfortable, Mom. Don't you worry about a thing. I am not going to sell when the market goes down. I'm like, babe, you know I love you. But I want you to understand when the market's going down, it's nauseating. Like even for me, I do this professionally. Like I was supposedly elite at my old job. And it still sickens me because you have made sacrifices, you've saved money, and suddenly your assets are worth, I don't know, 60% as much or 70% of as much. It's not fun. So I'm trying to say that to them. But what I tried to say to my kids is, I'm very confident it's going to happen, especially since they're so young. And so I said, let's just prepare for it and get excited. Because unlike me, because I'm old, you're young. And so you're going to invest when the market is cheap. Why? set up your retirement plans, your savings plan, so it's automatically investing. You don't have to think about it, and you're buying everything on sale. I would spend some time after this call, and you could look at the last lecture we talked about asset allocation, but review it and make sure um, that you're comfortable with whatever it is, right? So how would I do that? I tell my students that for my own personal asset allocation, which is really what that means is how much percent I have in my real estate versus my stocks versus my bonds versus cash or anything else. Just how have I divided it up? That's all the allocation is. What I do and what I've had my kids and what I told what I did for my clients, your investment advisor will also often give you these surveys. They're biased, all right? These surveys by almost every investment firm are supposed to help you decide how much risk are you comfortable with. And so they are biased, just my opinion, because the whole investment industry makes more money if you take risk than if you keep the money safe. So I certainly feel like if I phrase a question to you and say, like, how would you feel if your assets go up by 50%? You're going to feel great. But if I really framed it in terms of loss, you'd feel much worse. So how would I do it? I take I don't know, 6 months or at least once a year, I look at the dollar amount I have in stocks, the dollar amount I have in bonds, the dollar amount I have in real estate, whatever it is. My real estate probably isn't gonna like because it's not marked to market like a stock, it doesn't adjust its price every moment of every day in front of me, right? I kind of exclude that. I'm not going to move anytime soon. Then I look at how much the dollar amount I have in cash, let's say stocks and bonds, very simplified. If I own alternative investments or something else, I would include all those. And what I do is I say, what would happen if my stocks went down by 50%? So I have an Excel spreadsheet. Let's just say I have my net worth is $200,000 and I have $50,000 in cash. I'm making this up. And I have $100,000 in stocks and I have 50,000 in bonds. So what I would do is I have a hyperlink. I show right next to my net worth. I have another page another cell on my Excel spreadsheet, and I show my stocks worth half in dollar amounts, not percent in dollar amounts. So my $100,000, my net worth initially in my example was $200,000, but I show it as if now my stocks, instead of having $100,000 in stocks, I now show I have 50,000. And I label this stress test because what I want to do, my cash, I show the same amount. So if my initial example for those who are writing this down, $50,000 in cash, $100,000 in stocks, and 50,000 in bonds. So I have a link showing my stocks are worth 50% as much, show my cash are the same, not losing money in cash. It's going to stay the same. And my last thing is I take bonds and I assume that they're worth 80% as much. So these are very extreme corrections, right? I'm not saying I think stocks are worth going to go down 50%, but I can tell you when I was in business school and I was studying the theory of markets, they basically said like corrections of like, I don't know, I don't remember, but between 30 and 50% were so rare, like it might happen once in my lifetime. So I'm thinking I'm patting myself on the back. I'm feeling so smart when I graduate from business school. Within a few years, we had the correction of 2000 by 40 to 50%. Same thing for 2008, and then I had 2020. So let me just tell you, it's better to be safe than sorry. So if I see visually how much my assets are worth, if I'm willing to stick with that, then I can like sleep well at night and I'm not going to change it. That's what I say to myself. That's what I say to my clients who say to me, I can afford any risk. I don't freaking care, even if you're wealthy and don't like it when the market goes down. So that would be how I would assess that risk, whether I'm 20 to 50 or 51 and above. I would optimize my investments, and we talked a lot about this in the last lecture, so you can watch that online. And this section I would watch was on target date funds. I think that's a really good solution for most people at CU. It's not a recommendation, just learn about it. And then make sure you have enough cash to cover unexpected events. And then if you're in this age, and I said this to my kids, like the best thing you can do is invest in your own human capital, building the next generation of skills to keep on within CU, like, or wherever else to make you more valuable. And because the more we make, ultimately, it does help us reach financial independence faster. And I also told my kids, I think they should think of themselves as if they are a bond. So a bond is simply a debt instrument that pays me a certain amount of interest every 6 months. But essentially, it's a predictable form of cash flow. And that is really what I am. That's what all of us are when we're working. We have jobs. So for this group, it's really less risky when the market goes down because we have earnings. We're not living off of the portfolio yet. And then if I'm above 50, I would look at a little different, and some of it depends on when I want to retire. Same thing, like make sure I'm maximizing my savings to build the biggest base of capital before I retire. Understand my retirement time frame, because even if I'm 50 and I want to do early retirement and I don't have para from CU, it means I need the portfolio to grow and support me. If I'm lucky enough to have para, that's awesome because I actually can afford to take more risk because my portfolio is guaranteed to give me a certain income stream. Reassess my safe allocation. Like, how much do I really need so I can sleep at night? That analysis is very similar to what I called, like, before my spreadsheet, where I'm looking at my stress test. And then review your portfolio, especially your stock exposure, and plan your withdrawals. And so most people should be thinking not only of the portfolio giving them enough money, but also combining it with Social Security. And then anticipate lifestyle changes. Like, so are you planning on helping your kids in any way? Are there any extra obligations? Is your spouse, do they need extra income or extra help? And then think through like your insurance plan. I'm not a big believer. This is my opinion. It's not investment advice. I don't think investing should be mixed with insurance. Generally, this is my opinion only. I like things like fixed term insurance. It's much cheaper than whole life, universal life, all these elaborate plans. And so that's just generally what I would do. I'd take the difference if I had a whole life policy or universal, I might take that money I was already saving, but invest it on my own. Okay. Any questions before I talk about 401ks?
Yes, Diane, a couple in the chat. Michelle asks, I've heard that if one has a goal that is more than 5 years out, so for example, a down payment for a house in 10 years, then a brokerage and stock market allocations would make sense to save up for that goal. But how do you recommend tapering back from the stock market to saver accounts, for example, HYSA, the closer you get to that goal? It would be so sad if year 10, everything was still in the stock market and you had to sell at a time when the market is down.
Yeah, that is absolutely true. And it may happen. And so because I think these are great rules of thumb, that I really would not be investing in the stock market if I needed that cash. I'm going to start with 3 years. And I would expand that to 5 or 10 cash they really need. There's a good book out there. It has a crazy title. It's called it's Ramit Sethi is the name of the author, and it's something like I Will Teach You to Be Rich. So it has a very cheesy title. I do not like his Netflix show. And I also don't love all of his like podcasts. His book is fantastic. And this is related to your question because he went to Stanford and he got all this scholarship money. So this is money he needed within a 4-year time horizon, and equities were only going up, stocks were only going up. So he's like, oh, this is easy money. And you can imagine where this ends up. He lost oodles of money, scholarship money that he needed. So if it's a home down payment, if it's a debt obligation, if it's anything I need to pay, certainly within 3 years, none of that I would have invested in stocks. If it's 5 years or longer, you can have some invested in stocks. And I probably would do the same comparison I just talked about, which is pretend whatever dollar amount that you have on paper is worth 50% less. How do you feel? Right? If you feel sick to your stomach, which by the way, most of us would, probably it's too much if it would cause you to change. Meaning that if I had one client super, super wealthy and she just like we fought until like 11 or 12 o'clock at night. And she's like, I can't take it. I can't take it. I have to sell it. I'm like, I really, the best service I helped her with is like intestinal fortitude. No, we have to keep on going. And but most of us don't have like someone who's just helping them. So it's not an easy question because we are paid to take risk. I wouldn't put 100% of it in cash, but if it's cash they really needed in the next 5 years for a down payment, I would take some risk, meaning have some equities, but I'd probably pick a dollar amount that I would keep in something safer, maybe bonds that could pay maybe 4% right now, because I probably what I'm buying is peace of mind that I haven't lost all of it on paper, half of it or a third of it. Hope that helps.
Good. Thank you. A couple more if you're up for it, Diane,
Yeah,
or
I
we can save
am.
until the end.
No, no, please, let's go.
Okay. Isabel asks, what's your opinion on three fund portfolios and investing in international market funds, for example, Fidelity's Zero International Index Fund, especially given the fears around the state of the domestic market?
Yeah, so I like them. There's a book I think that's called The Three Fund Portfolio. It's by someone named Taylor Livermore. It's very simple to read. I think it's a great read. And essentially he said, really, to do well over long periods of time, you just need one US stock fund, you need one US international fund, and you need one bond fund, and kind of you're going to do as well or better than most. I think he's probably right. I think having some international exposure, it makes sense. There's something that's called home country bias. In every country in the world, we all believe in our country the most. And so I teach a class both on portfolio management and also it's a class in wealth management for MBA students. And all of them, when they design their portfolios, like they have to do this very elaborate project. And I look at them and I say to almost all of them, why are you putting almost everything in the United States? It's riskier to do that because, like, who knows? Like, the US is the leader right now. But who knows what's going to happen in 30, 40 years from now? I don't have to be smart enough to figure that out if I have some international and some US. And then I have stability with that bond portfolio. And that's what the three bond portfolio is. You could read about it at a website. I think it's on Investopedia. It is definitely Taylor Livermore. His book, I think, describes it. And it's, I think, very well written, very short.
Good. Thank you. Up for another one?
Yeah.
Sarah asks, I use a target date investment strategy for my retirement funds and the 529s for my kids. Do you suggest investing cash savings in the stock market beyond retirement and 529 accounts, assuming there are enough cash savings for emergency occurrences?
All right, let me make sure I've got this right. So we've set aside cash for emergencies. We are investing in the retirement plan already, and we have a 529 plan, and we have extra cash. Is that the
Yes,
question?
for emergencies. Yep.
Like the cash from the emergency fund, or we have extra cash to invest?
Do you suggest investing cash savings in the stock market beyond retirement and 529 accounts?
Yeah, so I'm just trying to figure out if I need to actually learn more about the stock market or I can just rely on the target date investment for my retirement and 529s, or if I
Yeah.
should take savings and then try to get more return on those.
Yeah. First of all, I'm a big fan of target date funds because if they're set it and so forget it. There used to be a lot of complaints on them. It depends where they are. At CU, we use really cheap ones. So if I'm doing it outside of CU, I'm not giving you investment advice, but I might suggest to a friend of mine, look at places like Vanguard, target date retirement funds, look at Fidelity, or look at Schwab, all three. Schwab maybe is a little more controversial right now because their stock itself is going up and down. I don't really know exactly why, but I'd say Fidelity and Vanguard would give me peace of mind. There's also a company that's called BlackRock that also sells them. The ETFs I like better than generally than funds because they're just slightly easier to move ultimately. So, for example, let's pretend I own an account. I have an account at Vanguard, and I decide one day I don't like them anymore. I want to move it to Fidelity. It's a little bit easier if they have this. Vanguard has the identical products for index funds and ETFs. And it's a little easier to move the ETF later. So I like those a little better. Why do I like them? There's a whole lecture on this last time, so please watch it. But most people try to tinker too much. As a matter of fact, I will tell you, this is not my study, and I have nothing. I have a son, I'm married, I love all the men in my life. Women, they've studied, actually, I'm going to give you two different studies. Like, who are the very best investors, right? And so it turns out, like, of all age groups, of all different sexes, and the best investors are dead people. So after you've passed away, the accounts are often inactive for a while and until the family settles the estate. And so dead people, ultimately, those accounts do the best. If I were to divide between men and women, not my study, nothing to do with being sexist. Women traditionally perform better than men because they make fewer changes. And men want to sometimes, like my husband is like this. He wants to tinker, have fun. They change things. And so changing usually makes it harder because like we get excited about the latest and greatest and performance, not always, because there are many, many famous men investors. But on average, if I study either Vanguard accounts, TIA, Craft, or other companies, so I like target date funds. I like over long periods of time. I don't know anything about your financial situation. For my kids, though, I said to them, I like them investing, and I am investing even now. Slowly but surely, I take a fraction of a large percent of whatever I make, and I invest it, even though I just said to you, I think the market's expensive. But you know what? I probably am going to live at least 30 or 40 more years. Erin's promised me that. Um, and that by attending her lectures. And so I just feel like, you know what? That's a long time for the market to come back. So, Sarah, the answer would also be like, how can I stick with it? Am I going to be hitting myself if, like, in the face, I like pretend like slapping myself because I invested and the market went down? And like, I would say to myself and even my kids, like, okay, like, there has just statistically never been the longest period for the entire US stock market to break even was 17 years. That was only once. All other corrections were much, much faster for the market to come back. Do I think it will, when it corrects, it's going to come back like 2020? Highly doubt it. But I think capitalism works. And I think what I mean by that is all of us on this call have CU's plan, which is invested in public companies through our retirement accounts. And so all of us are owners in the US markets or markets generally. And I think there are incentives that as long that they're well aligned, and sometimes a little too much, sometimes there's other stuff that goes on, but ultimately, as long as that structure exists, I think we will ultimately get rewarded as investors. The other thing I would keep in mind is I used to say to my clients, okay, like I had this one client, he's a very famous venture capitalist. And I always call clients much more when the market was going down than when the market's going up because they, like everybody else, were worried. And so I'd call him, market's going down, and he'd say, "You're telling me I should put on my seatbelt." And we had this conversation. What he meant is that if we go on a roller coaster, it's a wild ride. In the case of the stock market, though, like we're buckled in when we're on a roller coaster, and we know in a roller coaster we're going to get off. And in the stock market, at least always historically, no guarantees for the future, always historically, if with enough time, it's been at a higher place. So he's like, I'm going to buckle my seatbelt in. And tactically, I just personally don't open my online accounts. I'm not going to look when the market's going down. Like that's gonna make me feel better to look at it. So I just don't look at them during those time periods. Next question.
Okay, we've got a quick time check. We have 7 minutes. Do you want to keep going with
I
questions or
just
move
don't
in?
think we can do it, Aaron. We're gonna have
Okay,
to do it
that's
next
okay.
time. I'm sorry, you guys. I'd like just got too into detail with what's happening. I honestly believe, although I would love to talk to you all about 401ks and whether I should do a 401k and IRA, do I do that if I have pair or whatever? Like we should be prepared and think through. There's more value for you all in being prepared for market volatility. What else do we got, Aaron?
Cool. Allison asked, I know there are a zillion factors that would weigh into this, but is there any benchmark, just to give a very general idea as people think about when to retire, of amount of net worth you need per year you think you will live off of, assuming a comfortable but not
That
excessive
is an
lifestyle?
awesome question, Allison. And I don't remember which lecture it was. I think it was the first or the second lecture I gave. These are all available at CU. And what you want to look for is it's called the 4% retirement rule. Um, Online, it's also called the Trinity Study. A good source to learn about this is Investopedia. I have to give a caveat. Most of the websites and TikToks and stuff that's out there, they're only half true. And so Investopedia, and there's another website I use called Bogleheads, Bogleheads. It's a like a very clunky looking website. It's fantastic. The investment advice there, fantastic. Both of those are like Bogleheads is not a for-profit company. And generally the rule is this, that I look or I try to predict whatever I need in retirement for spending. So I take how much I'm spending today, let's say, and I say, is that enough? Is that what I want? Now, probably I paid off my house. Maybe I haven't. Let me just figure it out. Totally worth doing. Let me model that. It doesn't have to be precise, but having a guess is better than no number. Okay. Start with that. And then what I do is I say, well, I am 50 and I want to retire when I'm 60, let's say. So that's 10 years from now. I'm going to pretend I want $100,000 just to make this math easy for us. And what I would do is I want a good life to me is $100,000 a year when I retire. Hopefully it's less, but let's just say it's 100. And I want to grow it by 3.1%. 3.1% a year between now and, in my example, age 60. Why? Because if I'm 50 today and I plan to save or spend $100,000, by the time I'm 60, because of inflation, $100,000 doesn't spend the same way. So for those who want to look up, there's something called future value calculators. Future value calculators. You could also search up an inflation calculator. And what you would do is you put in $100,000 and then 3.1 is historic inflation. So I'm just saying for 10 years in my example, and you could adjust the numbers depending upon if I'm 20 right now, or in my example, I said 50. And then here's what you do. So now I've taken $100,000 and I've inflation adjusted it. And you simply multiply that by 25. Multiply by 25. That's the same thing mathematically as dividing by 4%, which is why it was called the 4% rule. So let's just pretend the number was 100,000 because we can all do this number in our head. 100,000 times 25 is 2.5 million. So in that is how much I would need to save. That's how big my portfolio needs to be for me to retire. And then what allows me to do is every year I look at my balance and I could withdraw 4% of it, inflation adjusted. And I go into a lot of detail on another video. I'd be happy to talk about it another time if people want a review of it. It's an extremely important question. The next thing I want to add to that is if I were to retire and I wanted 100,000, I don't actually need $100,000 because Social Security maybe will give me $35,000. I don't know. I'm making it up. So that means I really only need a portfolio that's $65,000 inflation adjusted. Okay, I'm going to stay on it. It's 12:58. I want to ask that if you have any ideas for Erin or for me on what you want to see for the next talk, if you could write them in chat and Erin will send them to me or email me, it's just diane.hirschhorn at gmail. Oh, sorry, at colorado.edu, sorry. You can find me in my email on CU's website as well. I'm the only Diane in the finance department because we really are focused on giving you material that you care about. And all of these presentations are customized. So please let us know. I'm going to stay on. Erin, do you mind if we stay on for 10 more minutes or should we drop off?
Yeah, let's stay on for 10 more minutes. I can keep going with the questions, but
And
if you do have to drop off, we've got 1 minute left, so I want to be mindful of your time. Let's
exactly.
give Diane a little bit of love. She does
Oh,
this out of the
stop
goodness of her
this.
heart.
I
She's
don't
so
need
good.
love.
I think
I
we do.
I don't, you guys. She's like, Erin is just the nicest in the world. I do appreciate it because, like, I just want to make a difference. That's why I'm here, guys.
Well,
So
you are. I
we'll
know you
stay
are.
on.
Well, let's
Please.
breeze through some of these questions. Nils has a question. Do short-term bond funds like JPST count as cash?
So I don't specifically know JPST. So I
Forget
can't,
JPST, just short-term bond funds,
yeah.
which are not FDIC insured.
Yeah. So first of all, FDIC insurance is if there's a bank failure, everybody, the government will insure you for $250,000 per Social Security number. In the case of like when Silicon Valley Bank went over, they insured people for the full value. So that does give me peace of mind. I would say like short-term bond funds, as long as they're high quality,
Yeah.
they could be a substitute. I would still not have all my money in it. But I think that you could probably pick up some interest if you did that. It's not, it's pretty close. I'm not going to say it's identical, but I think it's a fine place to park cash and pick up some yield. That's what I would say. I would say to everybody else, there's a lecture I gave. It was the first one I gave, and it was talking about how to earn more money on their bank accounts. And you could kind of get close to the yields on short-term banks, not for from money market funds, essentially. Probably most of us could make 3.5%. Probably most of us are making 0.01%. And I gave a whole lecture. Please look it up. It's really low-hanging fruit. It's easy to do. Next question.
Well, Catherine asks, what are your thoughts on keeping some of the liquid part of your portfolio in physical assets such as precious metals? In these uncertain times, I sometimes think if everything went completely pear-shaped, I would want some silver and gold on hand. I worry that.
Yeah, I mean, this is such an interesting question. This is really peace of mind for you. Here's my problem with precious metals generally. This is only my opinion. It may not be yours, really, and this is subjective. Like, I guess in a time of serious crisis, like we're totally, like the world's literally blowing up. It's like World War II conditions, right? Bombs. And I wanted to get out of this country, and there was a safe way of doing it. I imagine having physical gold would be something that is better than like money probably isn't worth as much at that time. But that's a pretty darn extreme example. What I don't like about precious metals or commodities generally, when I think of how a stock makes money, companies make money, or I make money owning a stock because it's a company, it's earning money. I'm a owner of it as a stockholder. I get a share of the profits. I get dividends or the stock price goes up. Easy to understand. If I'm a bondholder, like Niles was talking about, that's a contract. It's a loan and it's a promise to pay me a certain amount of interest. And generally, it works as long as the bank does it. I mean, the bond doesn't default, which is unlikely, possible, but unlikely. Niles, I'm going to say high quality short-term bonds could be a substitute, not low credit quality. I meant to add that before. And then the third thing that we're talking about, these commodities, like how do you make money with commodities? You only make money if they become, it has no inherent value, gold, right? I mean, it's used in mostly for jewelry. It's used in a few small places commercially, but pretty much the only way it goes up like it has in the past years, because everybody thinks the world's going to blow up, so it becomes more popular. Look what happened to it in the 1970s. It had an amazing run and then it didn't do as well. And there, if you look at the long-term performance of gold and silver, um, since the beginning of time, it's not so great. It's probably less than you could earn in a very short-term bond like a T-bill. So I would rather own things, even though it makes me nauseous when the market goes down. I don't personally have a lot invested in those categories. I just don't think it's just a popularity contest. I was never popular in high school, and I'm not smart enough to pick the next time gold's going to get better or worse. Next.
Awesome, Diane. I'm seeing some notes that yes, this slide would be great to pick up on next time. Other folks giving you love in the chat. We've got some links to your previous workshops. So just for those of you that are looking on the Let's See You Well page, all of the financial, so most of them have Diane's name in the title, and if it is a financial workshop, it's Diane. So there's one I think in there that doesn't have her name in the title. I know. But she's our resident financial guru.
Oh, okay. If anyone, I'll still stay on for another 2 minutes if anyone wants. If not, I'm happy. Or I guess 6 minutes. Anyone have any other questions? Thank you, Kaylee. That was very kind of you.
Well, and Diane's taking time with us. She's out visiting family, so grateful for her for all the happiness and help she brings to our community. You're the best,
Oh,
Diane.
stop thanking
I
me,
know.
Erin. If I do
I
this,
can't
we
help
have
it.
to stop this.
I can't.
You're the best.
Well, it looks like
Okay.
there's a great appetite and kind of gratitude related to this content. So let's keep them going. Everybody be on the lookout, and I'll send out
Okay,
more
and I'm
information.
sorry to everybody by not getting to the 401k discussion. I promised to do it next time. And I just could keep on talking always. So thank you so much. I really appreciate the opportunity. Erin, you're such a wonderful person to work with. I love your work. Seriously, you make it so easy and so fun.
Well, it's easy to work with you too in our great community. So we'll sign off for now and see you at the
All
next
right,
one.
take care.
Thanks,
Bye.
everybody.